Hi, everyone. I'm Jose Rivera, the CEO of CSIA. Thank you for attending this month's CSIA webinar. In today's webinar, Martin Riley, the CEO of CFO Performance Group, will explore 5 essential tips for accelerating profitability in your system integration business. The CFO Performance Group uses these same principles with all their clients. You will walk away not only with the knowledge to improve profits, but you will also see some examples of how we model financial performance. This webinar is part of our efforts at CSIA to promote adoption of our best practices. Financial management is Chapter 4 of our best practices. Martin Riley will also present at our 2017 Executive Conference in Fort Lauderdale, May 2nd to the 5th. For today's webinar, be sure to ask questions in the Q&A box, not the chat box. Questions will be answered during the webinar, so be sure to ask them. The webinar will be archived for later viewing, and the slides will be available also. Software Toolbox. The host and sponsor of our monthly business topic webinar is Software Toolbox, a CSIA partner member. Software Toolbox understands that you're not just buying software licenses, but are investing in a supplier relationship. Software Toolbox has supported CSIA since 1997 and seen the CSIA best practices grow into the great tool they are today. In Software Toolbox's best practices recommendations is to advise to think carefully before writing custom code and only to do so when no other solution is available. Custom one-off applications are filled with risk and hidden costs when evaluated over the full system lifecycle. Software Toolbox highly configurable off-the-shelf software products and support services are proven to lower system integration risk. In keeping with the ongoing continuous improvement theme of these webinars, they remind CSIA business owners about their free white paper that discusses 10 trends for industrial decision support systems. This software application space has historically been filled with custom applications or solutions built on spreadsheet spaghetti. Learn how smart system integrators are moving away from custom and leveraging their latest technology to help their clients. Practice some continuous improvement and read this paper to help you provide new insights to your clients. Download the free paper at softwaretoolbox.com/CSIA August 2016. I would like to introduce today's webinar presenter, Martin Riley, the CEO of CFO Performance Group, a CSIA partner member. Martin Riley has been a visitor speaker since 2010. So without further delay, here's Martin Riley.
All right, good morning, and thank you, Jose, for the nice introduction. I'd like to welcome everybody to this talk on 5 financial tips for greater profits for system integrators. So I am a small business finance expert, and I've spent the last 25 years of my career developing financial frameworks and tools to help small, medium-sized businesses just like yours build long-term profitability, or what I would call value. Now, I know that being a systems integrator can be very rewarding work, and although this feels great, it's not always easy to make your services highly profitable. It's difficult to find solid engineers, it's difficult to predict sales, and sometimes cash flow can be a strain. But there are some things that you can do to offset these problems, and this morning I'm going to help you do just that and help you to become more profitable. You may have heard the phrase, you need to run your business by the numbers. But what does that actually mean? Today, I'll give you the knowledge, tools, and guidance that you'll need to start running your business by the numbers and thus making more profit, which will lead you to meeting your business goals. Now, in the next short hour together, I'm going to give you 5 financial frameworks and a few easy tools that you can use in your business to help put you on a track to managing your business by the numbers. Now, there'll be a lot of information coming at you in the presentation, but that being the case, my hope is that you'll identify with 1 or 2 things that'll make a difference for you. And then at the end of the webinar, I'll let you know how you can get these tools so that you can start using them in your own business today. I'll also make sure that I leave time at the end of the presentation for any questions that you might have. And as you're answering, and you're free to ask questions as we're going through the webinar. Now, if the question I think is going to be long, I might save it for the end of the webinar. Or if I think it's something we can answer fairly quickly, I'll answer it when it's asked. But that way I can get through hopefully all the information I'd like to get out there today. And then whoever would like to stay beyond that time to answer or to ask the questions, you're free to do so. So with all that being said, let's go ahead and get started with tip number 1. And tip number 1 is what I'd like to call having the investor mindset. And for me, this tip is probably the most important, because if you can nail this, then the rest of the tips will be much more impactful. So I'd like to get started with this little slide right here. I'd like you to imagine that you own this house on the left. And let's just imagine that you're raising or have raised your family in this house on the left. But you have this desire to build this house on the right, or improve your house to the house on the right. So I want to kind of go through a process to kind of highlight how we might make that become a reality. So first we would ask the question, why would we want to do that? Well, I think there's a couple of reasons why we might want to do that. First is, maybe it is that we want a better lifestyle. Maybe we want to have a nicer house to raise our kids. Maybe we want to throw nicer parties at our house. Sometimes we just want to have a nicer environment around us. And these would all be considered lifestyle considerations. However, you might also want to make this change because you think that perhaps you can make more money on your house when you sell it one day, that you can build the value of your house. So in that respect, you're thinking about this transition as an investment. And just like in our businesses, as a systems integrator, we have these small businesses. They are also a investment and a lifestyle. So once you've kind of discovered why you'd like to make this happen, this investment and better lifestyle, then you have to say, well, what do I need to understand about this decision that will allow me to move forward with it? So the first thing you might ask yourself is, well, do I even like my house? Do I like the neighborhood? I might want to know, well, what is my house worth today? And what could my house be worth in the future? What would be the cost associated with making this exchange? And where am I going to get the money, right, to make that happen? So these are all questions you would want to know to help you decide if you should be doing this. Once you've made that decision, then you have to decide how will we actually proceed with this transition. So first you would make a plan, right? You would hire an architect, and then you would segment out the different phases of the build. You'd come up with a budget for that. You then go to your bank and secure funding. Maybe you're going to take some of the money from your savings account along with that loan. Certainly, you're not going to pay for this out of your next paycheck, so that's why we would need the funding, obviously. And then we might get an appraisal done on the house to see where the value is today. We'll secure the contractor, start the work. And then lastly, we would have an appraisal at the end before we would sell the house. And then through that process, we're hoping to improve the value of this and understand the value of this house. Okay, so when we're looking at our house, clearly we are looking at this from an investor's mindset. And so in our businesses, I would like us to do the same thing. But for many of us in our businesses, we actually approach our business from what I'd like to call an operational mindset. So we're managing our business from the P&L most of the time. We're looking at the expenses, we're looking at the revenues, but we're not really looking at it from an investor perspective. So the way I like to define a small business, the way I'd like you to think about your small business, is I'd like you to think about it as an investment plus a lifestyle, just like we did with the house. And the reason why that we want to think about it as an investment is because there's some attributes about our business that can be improved if we think about it from an investor's mindset. And the reason why that we need to think that way is that our businesses have limited capital and limited resources. And so we need to be very efficient with our resources to make sure that we can reduce risk to increase our returns. Now, employing an investor mindset or an investor strategy in our business can mean hundreds of thousands to millions of dollars more in profit over the long haul of the business, over the long term of the business. So, whether you're going to run your business for the next, 10, 15 years, or whether you want to transition out of this business, that transition could be a transition to management, it could be a sale, it could be a transition to family, or again, just running the business. No matter what the situation that you're in, having this investor mindset will, again, mean more profit over the long term of your business. And so that's really what we're after. So just like the house, if we want to have this investor mindset, we really need to understand what value is, because that's really what's driving this investor is value. So I'd like to talk about value for a little bit. Okay, so when we were starting that house adventure, we had this vision of what that house was going to look like, that house on the right. And we had an idea of what the value of that house might be when we were completed. Now, in your business, we want to do the same thing, except that it's not as obvious to us what the value of that business might be. So what I want to talk about or give you is a definition of what value is and how you can determine what the value of your business actually is. So I'd like you to imagine this bubble that you're seeing on the screen here as your business. And this bubble is an elastic bubble. It can contract and expand. And the size of this bubble is going to represent the value of your business. So the way that we define value, or the equation that we use to define value, is adjusted EBITDA times risk multiple. And there are many ways in which you can value a business, right? And there's valuation specialists out there that do all sorts of different computations around that. But from our perspective, as small, medium-sized system integrators, we need to have a formula that we can use readily, we can measure easily, and has a basis of understanding amongst most business owners or evaluators. And so this adjusted EBITDA times risk multiple is such an equation. So I want to first define for you what adjusted EBITDA is. So EBITDA is a profit number. It stands for earnings before interest, taxes, depreciation, and amortization. So again, it's a profit number. It's something that we can measure right off of our income statement. And I'm going to show you a worksheet here in just a moment to help you do that. Adjusted means that sometimes our profit on our financial statements is impacted by things that really don't judge the true nature of the business or the profitability of the business. As an example, owner's compensation. So you as the owner, you might be taking a salary that is higher than what you would normally pay a CEO or president to run your company. So let's just assume or pretend that you could hire a CEO to run your company for $200,000, and you were taking a salary of $100,000. Well, what we would do in that adjustment is we would take your EBITDA number and we would add back that added $100,000 of excess contribution to kind of what we call normalize that profit number, so that we can compare it apples to other investment opportunities if someone's going to buy this business. So that's the EBITDA side and the adjusted EBITDA side. The risk multiple side, now this is really anybody's assessment of how likely it is that your business will continue to produce the same levels of profitability or greater over the long term. So if somebody feels confident in your business's ability to continue to produce the same level of profitability, then they will give you a higher multiple. If somebody looks at your business and they say, well, yeah, it's making profit, but I'm a little unsure that it will continue to do that. Maybe they're concerned that the business will not do as well once you leave the business. Maybe they might be concerned that your information systems aren't really giving them the information that they can trust or rely on. And there's a variety of other things that they might look at, and we'll get into that. But that would make them feel like there's more risk, and so they would give you a lower multiple around that. So if you take that adjusted EBITDA and you times that by a risk multiple, you come up with a value. Now, we do have a tool that we use to make this assessment, and it's called the Value Builder. And I'm going to talk a little more in detail about the Value Builder as we get along in the presentation. But what this Value Builder does is it'll ask you questions in 8 different areas of your business, and it will produce a set of dials and scores in each of the 8 categories, depending on how you answer the question. And then at the end, it will give you an estimate of value of where your business falls. And this estimate of value is based on an algorithm that's run against how you answered the questions in comparison to a database of 20,000 other small and medium-sized businesses. So it's an algorithm ran process. But at the end of the day, you're going to end up with this range of values. Once you have this range of values, then you can take that value, you can divide it by your adjusted EBITDA that you can calculate to come up with your multiple. So that's how we'll do that. And again, I'm going to show you how we do this in just a quick moment. Now, once you have this value, right, and you have your multiple, now you have an idea of where your business falls in relationship to other small business in terms of its value. So when we run this report, or when they've run this report over the 20,000 different businesses that they have, they've come up with this range of multiples. So most of the multiples will run between the low 2s and high 6s. These multiples are really based on a financial buyer. You may have a business or a system that let's say a platform company might be interested in purchasing for strategic reasons, and they may give you a higher multiple. But from a financial perspective, financial management perspective, and making decisions in your business month in, month out, year in, year out, we like to focus on this idea or this concept of a financial buyer looking at your business and judging your business. And that's how we will look at it. So there is a tool, and this is going to be, in fact, the first tool you're going to have access to is what we call a KPI trend sheet. So in this KPI trend sheet, what we'll do is we'll have different KPIs in here that we think are important for you to track and to measure really each month, but we have it here on an annual basis. And so the first measurement that I want to kind of highlight for you was that adjusted EBITDA. So you can take this worksheet, you can input your net income, your interest, taxes, depreciation, amortization, and then come up with an adjusted owner's comp, and it'll calculate out for you what your adjusted EBITDA is. I've also put a little kind of brief explanation here of what that calculation is off to the side so you can see that. But it calculates your adjusted EBITDA. Then off of the Value Builder, if you choose to take the Value Builder, and that will be something that we will offer to everybody that is on the webinar at the end of the presentation. If you take that Value Builder assessment and you come up with a value, you can plug your value into this worksheet, this KPI trend worksheet, and it will actually calculate out your multiple. So now you have your adjusted EBITDA and you have your risk multiple. So now that's a good starting point of understanding where the value is. Now, just because you have a value and you have a multiple, that doesn't really help you plan or look into the future just by having those two numbers. So the next worksheet that I want to pull up, the next tool that I want to pull up for you is what we use with all of our clients to make this idea of value a little more tangible and useful. So this worksheet here is what we call our valuation and ROI worksheet. And what this does is it helps us understand the historical performance of our business in terms of value. It helps us project forward what we would like to have in terms of value and increased value in our business. As owners and managers of our businesses, our number one drive, right, should be building the value of our business. So this tool is going to help us drive our companies from that value number. So in this example that I have here, what I have is I have historically listed numbers from 2013 to 2016. I've calculated a multiple, which comes off of the value builders that we've run. I've got historical revenue information from the financial statements, the income statements. I've got historical net profit numbers from my historical income statements, depreciation, interest, tax, and finally it calculates out an EBITDA, and I have my value. So what I would do in this model is I would determine what kind of an increase in value that I would like to see over the next 3 years. And in this case, just for a sample, I said that I'd like to see a 10% growth in value in the first year, so going from 3.3 million to almost 7 million. In year number 2, I'd like to see a 20% increase in my value to 4.4. And in year number 3, I'd like to see a 30% increase in value. I think it's important from an investor, again, to always start my process of value and then end my process or measurement at the end of any period with value. Now, once I've determined what the value needs to be, I can make some assumptions or some plans around where I want my multiple to be. Now, how would I do that? Well, if I have this value builder report and I know the different areas of my business where I am doing well and areas of my business where I'm not doing well, I can take the areas of the business where I'm not doing well, I can make improvements in those areas, I can make investments in those areas, remeasure my potential performance of the company as if I had made those investments, and I can remeasure and come up with a number of where that multiple would fall. So if I know where my multiple is going to fall, I know where I want my value to be, I can easily calculate an EBITDA number from that, and the model will do that for you. I can then back into what my net profit needs to be. Based on what my net profit needs to be, and I understand my net profit percentage, it'll actually calculate out for me what my revenue number needs to be. So now I can be very purposeful and intentional about the level of revenues that I need to get the valuation that I need for my company. So again, that's a much different approach than saying, hey, last year I did this, next year I think I can do that, which is how most of us will do our planning. And the problem with that is if you do that and let's say you don't hit your mark, the first thing that we do is we think, hey, I guessed wrong, right? And so what do? We go ahead and reforecast, we rebudget, and we move forward. And to me, that's really the tail wagging the dog. That's significantly different than saying, hey, I've got a target value that I need to hit so that when I transition from this business one day, or as I grow this business into the future, that value target will help me reach that goal. And so as I'm going along, if I start to miss my revenue targets, if I start to miss my expense targets, investment targets, then I'm not hitting the goals that I need to hit. And I don't know about you, but for me, when I think about it from that perspective, I kind of double down on my, resolve to make a plan happen, rather than just saying, oh, well, I missed. So this tool will help you plan out your revenues that you need based on a certain value. Now, the other way that you can go about this is you can say, well, you know what, I know a certain revenue number I'd like to target, and if I have a revenue that I want to target and I know a value that I want to target, then I can actually calculate what kind of a multiple that I would need to hit my value. So there's a couple of different ways to go about using this tool to plan your future revenue growth, your value growth, and your multiple growth by using this tool. And again, I'll send this tool out to you as one of the things that we'll be sending out to you. Okay, let's move on. So that's how we're going to use value, and that's how we're going to use this KPI trend worksheet. Okay, so I want to talk about tip number 2, which is that you use your assets to drive profit. You use your assets to drive profit. There we go. Okay, so anytime that we want to start a business, okay, the first thing that we're going to need is capital. And we're going to start this imaginary business with $5. Out of that $5, we're going to take $2 and we're going to build this box. And this box is a box and crank, has a slot on one end and a slot on the other end. We're going to take another $1 of that 5, we're going to feed it into the slot, and 4 months later, out the other end of this box is going to come $1.50. Okay, so the question is, what did I make on my dollar as it came through this box? And the answer, of course, is 50 cents. That 50 cents is what we call margin. Now, if I can turn my dollar through this box every 4 months, then it means that I can put my dollar through this box 3 times in a year. This 3 times is what we call turn. So if I put my box 3 times through the box at a 50-cent margin, then it means that my box can produce $1.50 worth of profit. Now, I'd like you to now consider that this box is a profit center. So this is just a profit center in a business. And in your systems integrator firms, you might have multiple boxes and cranks or multiple profit centers. And each profit center should have its own set of accounting and an analysis. The profit that a profit center will produce, this $1.50, is what we call contribution. Contribution, okay? That's a little bit different than profit. Now, let's assume that in this box, I can cut a slot in the top of this box. And instead of feeding my dollar at the end of the box, I'm going to actually feed it to the top of the box. And because I feed it to the top of the box, the distance that my dollar needs to travel through the box is shorter. So now, instead of every 4 months, I can now put my dollar through the box every 2 months, right? Or 6 times in a year. So if my margin doesn't change, it stays 50 cents, and I can now put my dollar through the box every 2 months or 6 times in a year, then the profit or contribution that my box can produce, or my profit center can produce, is now $3. Let's say that to get that 6 turns, that I needed to decrease my margin a bit to get that 6 turns. So I put a caveat here that I'm never a fan of cutting my margin for purposes of getting more sales, okay? I think that sets up the wrong value, in the minds of my potential customers, and that leads to what we would call C&D clients, which I'll get to in just a moment. However, if I can go to my clients and I can say, I am willing to give you better pricing if you are to pay me earlier. So in other words, I negotiate terms of payment with them. If I negotiate terms of payment with them and I give them a discount for that, then what I'm saying is that you give me something in return for a reduced price. So now it's not me cutting the value of my service to them. I'm really just negotiating a deal with them. And so if I can negotiate them to pay me quickly, then even at a reduced margin at 6 turns, I'm producing a contribution of $2.40, which is still significantly better than $1.50 that I had originally earned in this box. So in kind of this tip number 2, where assets drive profit, there's a couple things going on here. One is I never really discussed the profit and loss statement here, which is where most of us look for profit in our businesses. What I discussed here was using the capital of our business through our business box and crank, our business machine, to produce profit. That's the true roots of profit in our business. And the other important piece here is that I used negotiation as a tool to help build profitability out of this box and crank. So I want to just continue just a little bit further. What if I did put my box through my box 6 times in a year at a 50-cent margin? What would be the revenues that I could produce out of this box? Well, this box could produce $9 worth of revenues if I took my dollar of capital, fed it through this box 6 times, $9. This $9 is what we call capacity of revenue. So this box can produce $9 worth of revenue. And so we all are some of us may be familiar with capacity, and we're going to talk about that here in just a moment a little bit further. But capacity is really made up of 2 components. Most of us look at capacity in terms of our revenue, or excuse me, in terms of our labor pool. And I'm going to give you a model to help you understand that. But there is also a capacity of revenue through our capital, which can also be measured. So both of these pieces are important to measure. So how do we measure our box's capacity in terms of labor? So we have a kind of a simple model that I'm going to share with you. We use this same model in our practice, except ours gets a little bit more customized, and you can customize this. But this is something that you can start off with to help you understand the capacity of your box, at least from the labor perspective. The way that this capacity model works is we list all of our employees down this left-hand column. We'll then put a number in here of the full-time equivalent that employee represents. So if they're working full-time in this profit center, then it would be 1 FTE. If they work part-time, I'd put 0.5. We'll put in a pay rate for them on an hourly basis. I'll put in a tax rate, your payroll tax rate. I'll put in the number of standard hours in a year, and typically that's 2,080 hours. I'll list any holidays that our company pays, and I'll list the PTO up here. Now, out of that, it's going to calculate for me what the salary is and payroll taxes and total payroll with taxes is for this particular employee and all the employees that I list in here. It's going to list my total hours, holiday, PTO, and if I take my total hours, subtract out my holiday and PTO, guess what? I come up with my available hours. Pretty straightforward. If I have a targeted utilization that I'm trying to hit for each of my employees, I can put those utilization rates in here. This will then give me the total billable hours that I have available from each employee. And again, each of these, targets can be modified to fit whatever it is that you want, and the model will make the adjustments. You'll put in a market bill rate, right? So in this case, 110 for this employee right here. And so this employee should be able to produce for me $179,000 worth of revenue in a given year. And then it will calculate out here this labor multiple for you as well. So if I have a labor revenue capacity of 179 and their cost is 67, then it'll give me that labor multiple. And what you'll find in most of your engineering companies that your higher level employees, your management team and high level, will usually be in the low two labor multiple, and typically your lower paid employees should be in the 3 to 4 range in terms of labor multiple. But this model will help you calculate that out. It'll take all of your employees and it'll add up the total capacity of your company now on an annual basis. And it'll give you an annual monthly average as well. So again, it's very basic, and you can customize this, but it gives you a good idea of what the capacity of your box and crank is. Okay, so now this $9 is actually making a very big assumption. So our box has this capacity. It doesn't mean that we have clients that are willing to pay us $9 for our goods and services. So next, I want to talk about our clients. And let's see here. Yeah. Okay. I want you to imagine that this oval here represents the market. And inside this market, in fact, the market's worth $100. Inside this market, we've got clients from A to D. A clients being our most profitable clients, D clients being our least profitable clients. Out of this market, we have sales of $7. That means we have clients that are willing to pay us $7 for our goods and services. So that leaves us this obvious gap of $2 between what our clients are willing to purchase and what our box and crank can produce. So the question is, and this is rhetorical, is can we still be profitable with this gap? Well, the reality is I'm not really quite sure at this point, but what I do know is that I'm not maximizing my profit. So tip number 3 is that balancing this gap between capacity and sales is how we maximize profit. And think about it this way. The $7 that our clients are willing to pay us is what's going to show up on our income statements as sales or revenues. However, the expenses associated with those sales that are going to be on our income statement is going to be based on the expense structure of this box at $9. So if our sales are at 7, our expense structure is at 9, well, we're not maximizing our profitability. So we need to manage this gap. And the way that we manage that gap is by having this labor capacity model, which tells us each month what the capacity of our box is in terms of revenue. And we look at our sales pipeline, our sales backlog, and we look at what we think the sales are going to be for the given year or given period to see what that will be. And if we have a gap, now we clearly have the information we need to either go to our sales team and say, hey, we need more sales, or we can go to our capacity side of the equation and say, you know what, we have a problem with sales, we need to do something about capacity. So whether that's lessening capacity or increasing capacity. But every month, if you meet with the sales team and the operational team with both of these reports in hand, identifying the gap, you'll go a long ways to fine-tuning that gap, especially over time as you get used to using the tools. So this is what we would call balancing capacity and sales to maximize profit. Okay, now, there's one other little piece that we have to talk about as it relates to this part of the model, and that is these A and D clients. So the amount of these sales is important, but it's also just as important, if not more important, to understand where those sales are coming from inside the market. So what makes a profitable client for a systems integrator? A profitable client is somebody who understands our value proposition. They understand the value that we bring to the table to them, and they're willing to pay us for that value. They're also the type of client that pays us on time. And many times, they'll be an advocate for us in the marketplace. Okay, so that would be a profitable client for a systems integrator. A not profitable client, right, a C and D client, is somebody who doesn't quite get our value proposition. So they're always trying to talk us down in our price. They don't pay us on time, and sometimes they may be a detractor for us in the marketplace. So what we like to call, this is tip number 4, which is refining your value proposition. Because the value proposition is not actually a marketing statement. Everyone thinks that value proposition is a marketing idea. It's really a financial equation. What the value proposition is it's understanding your ideal client, it's building your operations to meet the needs of that ideal client, and it's selling only to that ideal client. That is truly what value proposition is. So think about it like this. What if I was selling to C&D clients? And this C&D client, they were talking us down in our pricing. Or because they don't really understand the value, they keep coming back to us to provide more and more service to them under the contract, right? What does that do to our margin? That's going to eventually erode our margin. So this $9 is not going to be reality because the margins were eroded. Or what if this C&D client doesn't pay us on time, right? So what does that do to our turns? If they're not paying us on time, it's going to lengthen this cash flow cycle that's running through our box, which is going to hurt our turns, which is going to hurt our contribution, and it's going to hurt the amount of capacity or sales that we can put through the box. So when it comes to your value proposition, what is important to do and understand is client-based management. And I don't have we do have a tool that we use for client-based management, but it's a little bit too complicated to bring out in this, this short time that we have together. But you can go online and find different client-based management tools. But I will tell you, some of the biggest turnarounds that I've had with some of my clients has been around this concept of refining the value proposition. I've had clients actually fire half of their client base, free up their capacity to take on the right types of clients, fill that capacity, and double their profitability going forward. So it's a big area to improve the profitability of your business. So just to kind of redefine what that value proposition is, because I think this is very important, is define who your ideal client is, build your box to meet that need, then sell only to those clients. So as an engineering firm, if you're trying to be a high-end engineering firm to the types of clients that want special attention and hand-holding, then you might build a box that has a high number of senior engineers that work on those projects. And for that privilege, they're going to pay a little bit of a higher premium for that service. If you start to then go down the road and say, well, you know what, there's all these RFPs out there, I can go get more revenue, but we're going to have to start trimming our price a little bit to make that happen, you're starting to walk down a path of not now selling to your ideal client. You're selling to a client that is maybe more price-driven than value-driven. And if you use that same box and crank to deliver, you're going to erode the profitability of that capacity. So anytime that you want to take on a different ideal client, that's okay, but you need to build a separate profit center for that new client. And so I would never recommend trying to change the ideal client or adding a different type of client to your mix and not building a separate profit center. Okay, I think that's enough about value proposition. Let's go ahead and move on here. Okay, so the last little part that I want to talk about here is building for value. And I think this picture really nails it. And a lot of our businesses look this way. We have this beautiful sandcastle on top. And as we look at other engineering firms, right, we think, wow, these guys really have it all together. Look how great their company looks. And it's because we're always putting our best foot forward. But then if we were to look under the surface, right, we can see that there's many areas of our businesses that are anemic. They've eroded away or they haven't been built. And so it really puts our value in question because the next big wave or wind that comes by could knock our sandcastle over and then, we have major problems. So to me, this is the typical small business picture right here. This is what our businesses look like. Okay. And there's reasons why that happens, and so I want to just talk a little bit about that. So first of all, I do want to talk about what drives value in a business. What are the things that we need to do to build the value of the business, which of course is what is most important to us as business owners. If we want to expand this bubble, build the value of this bubble, then the things that we could do is, one, bring capital into the business. Bringing capital into the business will expand the value of our business. We can bring people into our business. And of course, we don't want to bring in just anybody. We want to bring in the right people. That will expand the value of our business. Obviously, as engineering companies, we get that. We can bring IP or products into our business. That will expand the value. And we want to bring in clients to our business, right, inside our bubble. That will expand the value. And we don't want to bring in any clients. We want to bring in a client, okay? Now, at the same time that we're trying to do all of this, there are evil forces in the world, and sometimes it's ourselves. We drain the capital from our businesses, and that hurts the value of our business. We lose our best people, right? We don't retain them. So that hurts the value of our business. And, you know, we have those evil forces in the world, our competitors. They want to take our IP or products, they want to marginalize them, and they want to steal our clients. Now, of course, they're not interested in stealing our C and D clients. They are interested in stealing our A clients, right? So, as business owners, to build the value of this business, we're bringing capital, people, products, clients into the business, while at the same time, we're protecting the capital, people, products, and clients, okay? Now, typically, when we're looking at bringing these pieces into our practice or into our businesses, it's usually going to come in combination. So if we want to bring, let's say, new products or clients into the business, it might mean that we also need to bring capital. So if there's this planning idea that's going on. So this is what we're doing to build the value of the business. Now, there's some other things that are going on inside this business that we haven't talked about yet. So I want to kind of highlight those real quick. This box and crank doesn't produce on its own. It has to be supported. So we have an administration that's supporting the box. This crank and handle, it needs to be cranking continuously. So we have our COO. We need to have a strategic vision for our company. So there's our CEO. Someone needs to make sure that we have a strong financial plan that tells us that we're on track and we're going in the right direction, our CFO. We need to bring in A clients, right? There's our CMO, Chief Marketing Officer. And we also want to have information coming out of our business so we know how we're doing. We have our accounting. We have utilities, rent that we need to support that box and crank. And then lastly, this bubble, it's an elastic bubble, right? And it's very fragile. We need to protect it from a burst. So we have insurance, we have our attorneys, we have our CPAs, HR, IT, okay? So we have a lot of things going on inside this bubble that is there to support that box to make sure that it operates efficiently. Now, all of these things that are inside this bubble, we have traditionally looked at as expenses. And I'd really like you to change the mindset from expenses as an operator to investments as an investor. So as an investor, we need to make sure that all of these pieces are in place to make sure that this business is running correctly. And if we go back to our house example, we would never take a house and improve, you know, let's say the kitchen, and make this wonderful kitchen, and then leave the rest of the house, you know, old and dilapidated, right? We would make improvements all around the house to make that investment solid and well balanced. And we want to do the same thing in our businesses. Okay, so what I want to do is I want to kind of make some room here. If you've done the math, then actually, let me back up. If you've done the math, then we've got $3 worth of profit in the business from our 6 turns. Okay, I'm going to move that out here. Now, as we look at our business here, there's things that we do well inside of the business, and those things that we do well inside the business are what we call strengths. Everything that we do inside of this business that we don't do well is what we call a weakness, okay? Everything outside of our business that gives us an opportunity to go after capital, people, products, and clients as an opportunity then everything that happens outside of our business that threatens that is, of course, a threat. Now, all of us are probably familiar with SWOT analysis, and I'll get back to that in just a second. Okay, now, here we go. If you've done the math here, we started off our business with $5. We took $2 and we built our box and crank. We took another one of our $5 and used that as working capital inside our profit center. That left us with $2. That $2 is supporting all the other investments that we're making inside of our business, okay? The expense associated with all of those investments is $1. So if we take that $1, subtract it from the $3 of profit or contribution, then we're left with a net profit of $2. So as a investor, as an owner of this business, what we need to do is we need to take this profit and this capital, that limited capital we have in our business, sorry, okay, here we go. So we need to take that capital, we need to invest it into the strengths of our business to go after opportunities. We need to invest into the weaknesses of our business to go after threats or to protect us from threats. So this is what we call the fifth tip, which is being strategic versus opportunistic in how we build decisions, okay, or how we make decisions. So let me put an example out there. So let's say that you as a systems integrator have an opportunity to take on a very large client. And the large client is going to represent, let's say, 25% of your overall business. Now, as an opportunistic or operator mindset in your business, you will look at that opportunity and you'll say, hey, you know what, I think I can make money on this business. I think I can produce against it, so I'm going to do it. And that's how you make your decision. And that's what we would call being opportunistic. A strategic operator or an investment-minded operator of a business or owner of a business, they would take that same opportunity and they would say, yeah, I think I can make money on this project. And yes, I do think that I can produce against this investment, but they're going to take a couple of extra steps. They're going to say, how much capital will it take for me to take on this new client? Because remember, as we take on a new client, we're going to have to buy more materials. We're going to have to take on more accounts receivable, right? So we are going to need to have more capital to support that. So we're going to look at that capital and we're going to say, does this capital use for this opportunity fall within my strategic plan? I've done an assessment of my strengths and weaknesses. I know where I need to make the investments in my company to build a well-balanced business. And if sales is not part of that strategic plan at this point in time, let's say you already have a decent sales process, then if you make that decision to move forward, you're going to use the limited capital you had for that. So the strategic owner will say no. They'll have the discipline to say no to that opportunity so they can preserve their capital to invest into the other areas of weakness in their business that they've already identified. So perhaps they don't have a strong human resource process to find and keep good engineers, right? They will put that investment there first so that they can then leverage that platform into larger sales into the future. So the tool that I want to talk about that will help you do this SWOT analysis, that will help you identify where these strengths and weaknesses are in your business, is the Value Builder report that we spoke about earlier. So I had mentioned that this report will give you 8 different areas of your business and how well you are performing in each of those areas based on a questionnaire that you take. It will then give you this value. We talked about that. But the other thing that this report is going to do for you is it's also going to list out for you each of the questions that you answered. So one of the questions, just as an example, will be when comparing your most recently compiled financial statement, right, with the previous year, what did your revenues do? Did they decrease? Did they remain at current levels? Increase by 10%? So on and so forth. So each of the questions that you answer will show here. It'll tell you how you answered the question, and it'll show you what the optimal answer is and how many points you could increase your score by. So if you run this report and you have all 8 areas and how you answer your question in each of these areas, and you know how to optimally answer the question, you can now make a listing of the areas where you're strong. You can make a listing of the areas that you are weak in. You can take those areas that you're weak, and you can prioritize them and come up with strategic initiatives that will help you improve that question. If you understand, if you assume that, hey, we're going to be successful in implementing these strategic initiatives, you can actually rerun this value builder questionnaire and see what your new score and new value will be. If you understand the capital that you put into this initiative or a set of initiatives, and you understand the increase in value, now you can run a return on that investment. Now you can actually understand what kind of return you're going to get if you implement a strategic initiative. And I don't know how many businesses that actually can do that or actually do that. And now you can with this tool. And again, this tool is something that we're going to offer you here at the end of the presentation, which we're actually getting kind of down near the end of here. I know it's been kind of a lot of discussion and a lot of things coming at you, but again, I think if you can just walk away with a couple of ideas here, that's what's most important. Okay, so the five financial tips that we went through is, first and foremost, think like an investor. Understand that it's capital that you're working with here, and you want to get the best return on that capital by making investments inside your business. Second tip was using that capital efficiently to drive profits. So using negotiation, understanding your cash flow drivers in your business. And in that KPI trend worksheet, I have some measurements in there for you so that you can measure your accounts receivable turns, your WIP turns, your payable turns. Those are all things that drive that cash flow cycle, and that's in that tool that I'm going to send out to you. But making that capital efficiency drives profit. Third, we talked about understanding the capacity of your box and crank or your profit center and balancing that to the sales to maximize profit. Fourth, we talked about the value proposition, okay? And we used that to define the business model, looking at our ideal clients, building our box to serve those needs, and then only delivering to those clients. And then lastly, we talked about being strategic versus opportunistic, understanding strategically where our business is strong and where our business is weak. And then when we make decisions around using our capital, we have to be strategic to make sure we understand what the capital is involved in any decision that we make, and is that decision, does it fall within the strategic plan that we've already laid out? If it does, great. If it doesn't, have the discipline to say no. All right. Okay, with all that being said, then again, what I'd like to offer to everybody who's on the call today, or whoever watches this into the future, we will offer to you, if you go ahead and contact us, and I'll give you the information for that in a second. We'll allow you to run the value builder estimate of value at no charge. We'll send you that ROI worksheet. We'll send you the KPI trended worksheet, and we'll send you the capacity worksheet. As a little side note, I know there's some of us that struggle with getting strategic initiatives done inside our business, right? We all have the fires that we have to put out each and every day, and that gets in the way. I would like to suggest to you that you read a book called Traction by Gino Wickman. And he has a very simple and easy to follow execution management process that he evokes. So, or teaches about. So I'd like you to pick up that book if you do have a problem around execution. So if you're interested in getting these elements right here, then I'll offer that to you. Go ahead and contact me at martin@cfotg.com. And if you send that out to me or send me a quick note, just let me know that you'd like to get the free tools from today's webinar. Our team will send that out to you. Okay, we've just covered a lot in an hour's time frame. And so I'd like to open up the floor now to any questions that we might have, and we'll go from there.
Martin, this is Jose. I think we are at the top of the hour, so we will allow people to ask the questions to you through this website, through this email address. And I would like to close just out of respect to our schedule. So thank you very much for your presentation, and to all of the attendees, thank you for your participation. My hope is that you have several takeaways. Martin, thank you very much for the contribution of your time and expertise. Your presentation was very insightful. It was excellent. We wish you the best for you and your CFO performance group. Keep up the good work, and we look forward to having you for another webinar of this series, and also at our 2017 Executive Conference in Fort Lauderdale, May 2nd to the 5th. Thanks again to our host and sponsor, John Weber and Monica Anderson of Software Toolbox. And be sure to complete the survey for today's webinar. You will be directed to it automatically at the end of this webinar. It only takes 30 seconds to complete, and your feedback provides us with continuous improvement. This is Jose Rivera, CSIA CEO. Thanks again for attending. Goodbye, everybody.
Goodbye. Thank you.
And I have stopped the recording.